Hey everybody, Marty Mazzora. Good afternoon. The 28th of June 2016. I usually do your video after the close, but this is my window to do this today. So, market's experiencing a very nice rally, as you can see on the screen in front of you. The S&P's up 27 as I speak. Dow's up, let's see, 237 points. Folks, I don't want to be a party pooper. I don't want to tell you that this isn't the beginning of something special, but it may not be the beginning of something special. The market got super oversold by technical definition after such a tremendous drop over 2 days that a bounce would make sense. Now, does it mean that I'm suggesting we're going to come careening lower to much lower levels? It could, but it doesn't have to. Yesterday, I suggested that there was kind of an anomaly that showed up. The anomaly was the fact that the VIX index was down while the market was down, and that does not happen all that often. And I have a chart, there it is, that I wanted to share with you. What you have in front of you are actually the 15 times, including yesterday, that the VIX went down the same day as the S&P went down more than 1%. It's unusual, only 15 times since 1990, so the last 25 and a half years. It's so unusual that one of my research providers did a chart on it yesterday, and that is what you have in front of you. These are days when the S&P went down more than 1%, while the VIX went down as well. What's happened the next week and the next month after that? Well, the VIX continued to go down on average 2.2%. Over the next month, 3.4%. Over the next week, the S&P was up 0.85%. It's up more than that right now. It's up about twice that right now, just today. And over the next month, it was up a very nice 3.53%. These are the median results as well. So of the 14 times that we have the follow-up data on, 3 of those over the next month we're down, 5 times over the next week. It just suggests something odd. And as I suggested yesterday, what it meant to me was that options traders were backing away from the fear, from the idea that there was more really bad stuff to come. Doesn't mean they're right. Doesn't mean a new set of data or new information wouldn't come their way today that would change their minds. And it doesn't mean that this isn't just an oversold bounce and we'll have the VIX spike up tomorrow and the markets trade lower, but the VIX is off 19% today while the Dow is up 1.5%. That's generally the typical relationship, as I shared yesterday. So, excuse me, unusual. History suggests that it bodes good things. The other thing that's gone on today that is pretty consistent with the story I've been telling you lately has to do with breadth. And this one was a couple of hours ago. In fact, tell you what, if you'll bear with me, I'm going to come over here and update the breadth and see where we are. And breadth, you can look at it from a number of ways. This is advancers versus decliners. And so what you see in front of you now, the Dow, as we speak, 27 of the Dow 30 stocks are up while only 3 are down. The S&P is, gosh, that's almost a 10-to-1 ratio. 457 are up while only 47 stocks are down. The NASDAQ has good breadth. The Toronto Exchange has good breadth. The Mexican Exchange has decent breadth. The Brazil Exchange even has decent breadth with all their problems. For whatever reason, Chile must be selling off today, and then Colombia for what it's worth. But look at Europe, the Euro Stoxx 50 index, and folks, many of you have an ETF that tracks this index. It's 50 of the largest European stocks that aren't domiciled in the United Kingdom. As you can see, tremendous breadth there today. Just about all of them are up. The FTSE 100, which is the United Kingdom, believe it or not, is showing pretty good breadth. And across the board, when you look at France, Germany, and the rest of the countries and regions in Europe, very, very good breadth today. So this is definitely a rally where stocks are bouncing back in very strong fashion. Now, the breadth on one day probably doesn't tell us a whole lot other than it's a good broad-based rally. But what I've been seeing and what I've been talking about is that as this rally has gotten into this stage up here, the breadth has really improved, meaning most of the ships have been rising with the tide, which is something we haven't been seeing in this market for the last couple of years. And it tends to be a pretty strong indicator of better things to come, and I'm going to say on an intermediate term basis. What I've been showing you here, though, when I jump to the technicals, that on a short-term basis, I've been pretty skeptical that this rally was going to last. Now, so to close, what you have in front of you is today's market. You can see we bounced nicely, and here we are trading close to today's highs. And these are what are called Fibonacci retracement levels. What you do is you start here at the bottom, you go up to the peak, and because rallies tend to go through these consolidation periods where they retrace a bit, and technicians look very closely at the 38.2, the 50, and the 61.8% retracement levels. That's why these are colored here in the middle. And they look for these to be areas of support. And as you can see, it found that support yesterday, closed pretty much right on it, and then bounced pretty hard off of it today. If it were to drop below that, then they would look at this as resistance and then the 50%. So folks, sometimes I will come to you and do a video where I have no explanation, and meaning there's nothing in the news, there's no big fundamental change that makes stocks go higher or lower. And sometimes it's just the technicals. It's money moving in based on levels that the market has achieved. So today's rally is what I would call a technical rally. It got oversold when we look at some of the short-term indicators, and we bumped down against that 38% retracement. The breadth is also what would be considered a technical indicator, but it speaks to something fundamentally more sound and more optimistic going forward. So again, I think we should expect that this market is going to find more volatility and very easily trade lower. Back here, I was talking about even 100% retracement. Even from here, that would be very much within the realm of normalcy for markets. And when you're long-term, patient investors, you realize that you live through this stuff. And I'll be here to help you put the near term into what I believe to be its proper perspective. Folks, thank you as always for watching and listening, and I'll be back very soon. Take care.